Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today we are going to have a special guest. His name is Mr. Jordan Roy Byrne, and he is the president and CEO and owner and everything else, I assume, of thedailygold.com. Link is in the description, as well as the Daily Gold podcast. Yeah, he is a precious metals expert, and I'm really excited to get some insight and wisdom about the precious metals markets, where they are now, where we stand, and where we may be going. You definitely want to check out thedailygold.com, and we'll be talking about that. We'll be talking about the podcast, as well as Mr. Roy Byrne's book, which is now considered a classic from 2015, The Coming Renewal of Gold's Secular Bull Market. Thank you so much, Mr. Roy Byrne, for joining me today.
Well, thanks for having me on, David, and thank you for the very kind introduction.
Well, it's all true. I wouldn't say it if it wasn't, so there you go. So I wanted to talk about, first of all, thedailygold.com. There's so much on this website. In your podcast, you've spoken to some of the same people I have, like David Morgan, Gwen Preston, and if people go on your website, what can they expect to see, and what will they get that's really special from the premium service that you offer?
Well, on the website, basically, that's just a collection of all my free work. The free work that I do podcasts, as you noted. I write articles. I tend to write one article per week. I also do maybe one or two interviews per week, so I post all those on there. And generally, my free work focuses mostly on technical analysis and where I see the market going and those kind of trends. Whereas in the premium service, I go into a little bit more technical detail, but the premium service also covers companies, junior companies that I personally invest in. So the premium service is kind of like, I like to say, it's a combination of market timing, which is technical analysis on the sector, and then stock selection. And so I'm focusing on the juniors that I like to speculate in and invest in, and I do cover the fundamentals of those companies. I don't just look at charts all day and not look at fundamentals. I believe that it's important to look at both, especially when you're looking at companies. So I do, even though I am a chartist, I do consider fundamentals quite a bit, and especially with picking the companies. So that's basically a rundown of what you'll get between thedailygold.com and then the premium service.
And I'm looking at the premium service right now. It's less than $1 a day, and you're getting all the research, all the due diligence that you do. And I know that you look at both the technicals and the fundamentals, so that's really something that people need to take a look at right now. But in the meantime, let's talk about price targets, if you don't mind. I've spoken to some of the other greats in the industry, and I've heard price targets for gold as high as $10,000. Silver, I've heard massive price targets. What is your outlook right now?
As far as long-term price targets, it's really hard to say. I mean, if we stay in the same monetary system that we're in, over long periods of time, metals prices will trend higher. But the one issue, I know I'm kind of being evasive with the question, but with those price targets, the one thing you have to realize is, if you go back to 1980 and that parabolic spike in both gold and silver, they didn't. They basically spiked. So you weren't. So when people say, like, let's just say $5,000 an ounce for gold, or $6,000 or $7,000, if there's a spike in there, that means gold is probably going to move from $3,000 or $4,000 to $6,000 very quickly. Same thing. And so if people are saying, silver could go to $200 or $300 an ounce, the spike could be $100 or $150 an ounce. So the targets sound great, but you have to remember that if there's a huge spike in there, it's not as if the metals are going to spend a whole lot of time at those very high price targets. If you look at gold against the S&P 500, I have a chart of that in my book. I think that's one way you can factor in. You can attempt to gauge, where gold could peak. And if you're looking at, the S&P 500 now, I think it's around 2,300, something like that. If you look at, I think, again, I don't have the gold S&P chart in front of me from my book, but I think for gold being 4 times the S&P is reasonable based on, going back 150 years. And so that puts gold at almost $10,000 an ounce. Now, we don't know where the S&P is going to be. The S&P could be higher, it could be lower. If it's lower, if it's at 1,500, 4 times 1,500 gets you 6,000. But who knows? Maybe the ratio is 6, and maybe the S&P is 2,000. So that comes out to 12,000. So that's how you can get some of these targets. But I kind of shy away from putting these really long-term targets out there because, for one, I don't really want to live in a world with gold at $10,000 an ounce. Right now, if it just went to 1,500 or even 1,800, that would be fantastic for a lot of the juniors. So I'm not sitting here holding out, thinking that metals prices are going to, reach these what seem like obscene levels right now. But again, if you look at ratios, gold to the stock market, silver to the stock market, you can make a historical case for these quote unquote obscene price targets. But I think when people put them out there, they're really based on they're really marketing targets. The $10,000 an ounce, that's a marketing target. I haven't when I hear that, I don't see the people talking about gold against the S&P 500 in that ratio, for example. I have seen, I guess some people, they do talk about, well, if the money supply was 100% backed by gold, gold could be this price. I get that, but for the most part, I just think these seemingly obscene levels are really marketing. They're inspired by marketing more so than analysis. So I'll just leave it at that.
Fair enough. Wanted to talk about your book, The Coming Renewal of Gold's Secular Bull Market. So much of what you wrote there has come to pass. Have things changed since you wrote the book? And how have they changed?
That's an interesting question. I am thinking of doing a second edition for the book. So a little news flash. If I have enough time, I would like to possibly do a second edition this summer. I'm a little surprised that the stock market did have a correction 2015, 2016, and it didn't evolve into a bear market. With respect to precious metals, I don't think things have really changed in the big picture, although we're really at a interesting spot, and I gave a presentation recently and I wrote an article titled "The Bearish Gold Bull" because I'm a little concerned that we could see some weakness in metals prices for the rest of the year, but I could be wrong about that. Looking at the gold stocks, for example, I think their bear market is over, and various companies are doing well. We're seeing takeovers, so various juniors are. We are seeing buying in the sector. Good news is being rewarded, even though metals prices are kind of lagging. They're trading below their long-term moving averages. All those things. So we're really kind of at an interesting conundrum as far as where the sector is right now, and if the bull market is really going to be reignited soon, or perhaps it's not really going to happen until we see the S&P 500 roll over and the U.S. economy get into trouble. That's possibly one catalyst for precious metals. But as far as the big picture and the things I discuss in the book, no, it really hasn't changed. The gold stocks I talked about in the book, they were extremely cheap, and due for a major recovery, and I mean that's exactly what happened. I'm not saying I predicted it. It's just look, that's one thing that it did kind of go as forecasted in the book, but with respect to gold and silver, they're at a kind of at a conundrum here, and so it'll be very interesting to see how they play out. And again, with the stock market in the book, I mean, it was rolling over, but it was kind of, I mean, I talked about gold against the S&P 500, the ratio of gold against stocks, and how that's a major catalyst. And it was a major catalyst for the 2016 move in precious metals, but that has kind of faded and rolled over as metals prices have faded a bit, and the stock market has kept going to new highs. And so I mean, some things have played out as expected, but because we're kind of in a conundrum here, that I think leads me to a good opportunity to do a second edition of the book and just kind of update people where we are and what might be happening right now.
Sure, and I would certainly look forward to that. You did reference the S&P 500. It seems a little toppy right now. A lot of people are saying that it's a little frothy at these levels. Should people be worried in 2017 and beyond? Should we be hedging with precious metals if we're long equities? What do you think?
Well, it depends what kind of investor you are and what your goals are and all that stuff, because blanket financial advice or analysis, it doesn't, it's not going to work. It's not one size fits all. I mean, generally, I think with precious metals, I think the smartest people who are extremely well diversified, who own just a bunch of different things, including precious metals, maybe they own 10%, maybe they're really aggressive. People own 20 or even 25% precious metals. Again, I'm talking about a very diversified portfolio. Excuse me. Mm-hmm. So it's very important to have some position in precious metals if you have a strongly diversified portfolio. But as far as the S&P 500, one thing to mention is there's really no reason to own U.S. stocks right now in a diversified portfolio, and that's because you can own foreign stocks, you can own emerging market stocks. I mean, you can own these other markets that have performed poorly in recent years, but they look like they're turning up. And now, if the S&P goes down 20 or 25%, has a bear market, these other markets are going to get hit. But the thing is, these other markets, they may not get hit as much as the S&P, and then when we get into the next expansion, after a bear market, then these other markets would really outperform the S&P 500. So there's two ways that you can do it and avoid U.S. stocks. You can have a position in precious metals, and again, depending on your risk and all that, I mean, it can be a small position or a little bit larger. But at the same time, the other thing would be you steer away from U.S. equities and you own foreign equities. I mean, there's countries in Europe, there's countries in Asia where these markets are very cheap. I mean, they're starting to turn up, so it looks like a good entry point. And again, as I said, yeah, if the U.S. has a recession, these markets will get hit, but they probably won't get hit as much. And then when the world recovers again, these other markets will outperform the U.S. So thinking over the next 5 to 7 years, I think most of these other markets are going to outperform U.S. equities.
Interesting. Looking at taking more of a global outlook. I've been looking at certain Latin American countries myself, so yeah, I totally see where you're coming from with that. We don't have to be stuck with U.S. equities at all. We can look elsewhere. And speaking of looking elsewhere, wanted to talk about some other metals that people may not have considered so much. For example, zinc, uranium. Are there any sectors in the metals markets that maybe people aren't looking at as much as they should be?
Yeah, that's a good question. I'll just warn everyone, I don't have as much expertise on these other metals as other guests, so I wouldn't take my word for it as far as what I say. But looking at uranium, I mean, we had this big recovery, and now, as far as the stocks, and it looks like it's faded. But again, in a really strongly diversified portfolio, it's probably reasonable to have some kind of weighting, a small weighting in uranium stocks, just because, I mean, this is a sector that was in a 5 or a 6 year bear market. Again, it had this big recovery, but it's faded. But nevertheless, in the big picture, uranium stocks, I mean, over the next several years, I think because of where they're starting from, I think you're probably going to do well in those stocks and outperform most other sectors. So definitely, there's a case for that. I mean, as far as zinc, that's it's a much smaller sector, a much smaller market. I don't know a whole lot about zinc, to be honest. I mean, analysts are saying the fundamentals are strong, and I mean, I'll just step back and one point I'd like to make, and with respect to zinc and base metals, is it looks like the next economic cycle, not only in the U.S. but globally, is going to be driven by massive infrastructure spending. Again, not just in the U.S. but other countries, because there's too much debt in the world, and when you have too much debt, lowering interest rates over time, it creates less and less of an effect of economic growth. And so therefore, that's why governments are going to have to pick up the slack, and while they'll be the real, again, fiscal spending will be the real driver of the next economic cycle, and we badly need infrastructure spending in the U.S. And in other places around the world. I mean, China, they're going to be doing lots of infrastructure spending through China, and connecting some other countries as far as trade routes. And I think that will really push commodities as far as the next cycle, because commodities haven't performed that well recently. But I think given this massive global infrastructure spending that could be coming in the years ahead, that could be a big driver for commodities and some of these metals like zinc. But I mean, here and now, it looks like zinc already has strong fundamentals, and zinc could continue to perform well. But I mean, I don't know of a zinc ETF. I think with zinc, you just have to look. You just have to look for things. I mean, if you're speculating in juniors, you have to look for things on a company by company basis. I mean, if you like a zinc company, that's great. If you like a uranium company, if you like a gold company, then go with those more so. That's kind of the route that I take, more so than thinking, okay, well, I really like zinc, so I'm just only going to invest in zinc.
Yeah. Makes sense. Now, would you apply that to gold and miners as well? For example, would you choose Hecla Mining, one of those, or several of those over in ETFs such as GDX, GDXJ, that kind of thing?
Well, that's a good question. It's actually something I'm working on right now, given the fiasco with GDXJ. It's very interesting because I think with Now to touch on what I said in my last answer, I mean, I like gold, and we can throw silver in there. I like precious metals because that's where my expertise is, and that's where most juniors are focusing on those metals. But it's interesting because juniors are super risky, but I think if you're looking at risk versus reward, I really like the juniors better than the larger companies, because if you look at larger producers, I mean, if you're producing, let's say you're producing 500,000 ounces of gold per year, I mean, you're losing your product every year. That's a whole lot of gold that, I mean, you have to replace those reserves. You have to have deposits ready for the future to be able to replace those reserves and maintain that production over time. And I mean, capitalism and industry, markets love growth. Markets are looking for growth. And growth, it isn't always the best idea for mining companies to be focused on growth. I mean, they can trip up over time. I mean, they can make bad decisions with respect to trying to grow. It's just, I mean, it's so much easier for a tech company to be able to grow than for a mining company to say, oh, well, we're producing 100,000 ounces and we want to get up to 500,000 ounces or 1 million ounces in the next 5 to 7 years. I mean, it's just so much harder for a mining company to achieve that growth. And that's why I shy away from the bigger companies, and I favor the juniors because of the fundamentals in the junior market. I mean, we know that larger companies in the industry, exploration hasn't been being done. the exploration that's been done in the last 10, 15 years. I mean, tons of money has been spent on exploration, but the industry has just not found enough deposits, and so therefore, where we are here and now, I mean, the valuable deposits are gaining that much more value because they're needed by the industry and the larger companies. And so if you can pick those individual juniors, you're going to do very well over time. So I prefer, rather than just putting money in GDXJ, I prefer build your own GDXJ, pick a basket of 5 or 10 stocks. And I think if you do that, you're going to do better over time than if you just bought GDXJ. I mean, if you look at GDXJ is based on something called the MVIS Junior Gold Index, and I looked at a chart of that going back about 13 years, and it's trading around the same level, which is horrible. I mean, that's what you get when you buy the sector itself. I mean, you don't want to own the whole junior gold sector. You want to try and pick and find the best 5 or 10 or 20 companies, depending on the size of your portfolio. I mean, over time as a stock picker, you're going to do much better than if you take that route compared to, well, I'm just going to sit here and buy GDXJ and hope that goes up. I mean, you'll probably make money buying GDXJ, but you're going to make a lot more money if you're able to build your own GDXJ, pick the stocks that you like best. And my last comment on that is, I mean, a lot of these companies, you want to buy them well before they're going into the GDXJ. I mean, you can find great juniors that do well, then they go into the GDXJ, and I mean, they're already a much bigger company, they've already had a big move, and just the upside, by the time they get into that index, the upside is so much less. So, I mean, that's another reason why I favor the juniors and the smaller juniors. I mean, by the time they get too big and there's all this money buying and selling them like we see in the GDXJ, they don't have that much upside. They're generally just going to follow the sector at that point. So when something gets added to the GDXJ, I think it's kind of I don't want to say it's a sell indicator, but from a contrary perspective, I mean, it's not always a good sign.
Yeah, interesting. I like it. So ETFs, not a perfect solution all the time. Maybe it's better to pick and choose, and as you said, build your own ETF. And when it comes to these companies, bigger is not always better. A lot of actionable advisement here. Of course, now disclaimer, we are not giving any advisement as far as buying or selling anything. All the listeners to this have to do their own due diligence. But just one more quick question, a personal one if I may. Are you a stacker, and why or why not?
No, I'm not a stacker. I just prefer to focus on investing in juniors. I mean, I think at some point when I have the means to do so, I would like to buy a little bit of gold and silver every month. But I think I think you have to look at that as an insurance. You have to separate investment versus insurance. And I mean, it's fine if you want to buy metals and stack every month, so to speak, but I think you have to look at that as a financial insurance position, whereas for investment purposes, I mean, you can buy ETFs for investment purposes, the GLD, the SLV, the Sprott Physical Trust, or whatever. I mean, that's fine, but I think the issue, I mean, a lot of people who stacked, in the 1970s, they did great, but I mean, they're probably still holding that metal. They didn't sell it at the top in 1980. They kept it, and it obviously lost value in the 80s and the 90s. And so my point is, just figure out if it's an investment or if it's insurance, because if it's insurance, you can buy a little bit every month, and you could accumulate it over time and build your insurance position. But if you're buying it for investment purposes, you have to sell it at some point. I mean, remember that, because at some point in price, gold and silver will be a sell. It will be time to get out and completely ignore it for several years. So I would just advise people, not giving advice, but I mean, that's my belief. Don't get confused about, it's buying an insurance position versus an investment position. Nothing wrong with buying it as an insurance position, but you don't want to confuse that with an investment position, because then if it's an investment position and you're holding physical, you're probably not going to sell it at the time when you should sell it. So I mean, that's the only issue there.
TheDailyGold.com is the website that people need to check out. It's going to be a link in the description of the video. People should check out the podcast, as well as the premium service at TheDailyGold.com, which is less than $1 a day for all the due diligence and insights that Mr. Jordan Roy Byrne does for you. Thank you so much for joining me today. Are you on social media, by the way, and how can people reach you that way?
Well, the best way to reach me, they can email me, jordan@thedailygold.com. As far as social media, I tweet occasionally. That's twitter.com/thedailygold. Also, I have a YouTube channel, so you can find a lot of my work there. Like this interview, I'll after you post it, I will link to it in my channel. I think my channel is thedailygold.com youtube.com/thedailygold.
Easy to remember, easy to find, and people should find it. Mr. Jordan Roy Byrne, I really appreciate all of your time today, all of your insight. Thank you so much for joining me on Looking at the Markets.
It's my pleasure, David. Thank you so much for having me.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.